The data tells me that there is a new buyer in this marketplace. But the central bank gold buying has propped gold up or held it up when higher interest rates and reduced tensions before October 6th should have been headwinds for gold. The higher dollar, there were a number of things that would have been a headwind for gold. There is a new buyer. It's not just central banks. There is a new buyer. Now, who is he or she? Obviously, it's not one person. I cannot tell you I know the answer to that. But there's a new buyer in this space that wasn't there before. And I do see that as very bullish. Yeah. The Fed, despite everything, is still talking about, it's just bumps on the road. We're still on track to cut rates this year. And if they stick with that, rate cuts are also very bullish for gold.
Gold prices surged to near record levels on Monday, propelled by a sharp rally fueled by heightened safe haven demand amidst the ongoing turmoil in the Middle East. The precious metal has witnessed a remarkable 20% surge over the past 2 months, with analysts projecting further gains in bullion prices. Lobo Tiggre, editor at the Independent Speculator, underscores the pivotal role of central bank gold buying in shoring up gold prices, even in the face of headwinds such as rising interest rates and easing geopolitical tensions. Tiggre emphasizes that central bank purchases, particularly by entities like the People's Bank of China, have provided steadfast support to gold prices, contributing to its resilience in the market. Goldman Sachs has revised its gold price forecast upward to $2,700 per ounce by year-end, compared to its previous target of $2,300. The company cites the metal's entrenched position in an unyielding bull market. Gold price's recent breach of the $2,300 mark, driven by geopolitical uncertainties and expectations of U.S. interest rate cuts, has drawn attention to China's significant role in shaping gold demand dynamics. The PBC's consistent gold purchases for 17 consecutive months in 2023 solidified its position as the most aggressive central bank buyer, underscoring China's growing appetite for gold amid global economic uncertainties. Tiggre suggests that geopolitical tensions, mounting inflationary pressures, and pervasive economic uncertainty may fuel new buyers' burgeoning interest in gold acquisitions, further cementing its status as a prominent player in the gold market. Market response to closely aligned official figures with Wall Street's consensus would only slightly sway sentiment. However, significant deviations in CPI data could trigger substantial price swings. Lobo Tiggre highlights the importance of persistent inflation perception, particularly in the U.S., prompting investors to turn to assets like gold as a hedge against currency devaluation. Come along as we explore the valuable insights provided by Lobo Tiggre. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
Invasion of Hamas into Israel. And the hockey stick inflection is really over the last couple months, so they're not the same event. I do subscribe to the view that many of my peers have, that central bank gold buying has been a big factor here. Now, that's not just recently, that's been ongoing. So the more hockey stick inflection point, I do see a new buyer. Now, I don't claim to have secret sources in the CIA or space aliens, monitoring out there on my behalf. So I can't tell you, Jeremy, that I know, this is it. And buy my newsletter and you'll find out the secret way to profit, right? That's just not the way I do things. The data tells me that there is a new buyer in this marketplace. But the central bank gold buying has propped gold up or held it up when higher interest rates and reduced tensions before October 6th should have been headwinds for gold. The higher dollar, there were a number of things that would have been a headwind for gold. And I'm sure we'll get there, but I think this is part of why the gold stocks underperformed, because there were visible headwinds for gold. And the central banks were buying physical gold, not stocks. So the stocks responded to the macro setting more than gold seemed to do. And suddenly now we have this hockey stick inflection point. I'm hoping that it goes much higher as a gold bug. So what I get from that, Jeremy, is there is a new buyer. It's not just central banks. There is a new buyer. Now, who is he or she? Obviously, it's not one person. I cannot tell you I know the answer to that. You've spoken to Rick Roll, and I'm sure he's told you, and our audience has heard before, that Rick likes to say that the average allocation to safe havens, gold, like gold in global portfolios is on the order of 2%. We're not talking crazy gold bugs buying putting everything in gold. We're talking about overall global asset allocation over the decades being around the order of 2%. And recently, it's only been on the order of 0.5%. So if people decided that they needed more of a safe haven, not necessarily because of today's news, but just the context that we're in today, That could be the sort of thing that brings this new buyer to the table. Over the last few months, people saying, you know what, we've got two hot wars, either of which could turn into World War III. We've got inflation getting sticky, right? And the world is just the sort of place where a bit of a physical safe haven asset might be a good thing. And that could be your new buyer. And I want to stress one point there. I said inflation being sticky, it's US inflation. And of course, the world is larger than the US, but commodities are priced in dollars. The gold price, I like to call the gold dollar exchange ratio because I think of gold as money, and therefore it's a Forex question. So it famously, though, your predecessor there at Kitco would always, point out to me that gold doesn't correlate very well with CPI. Mm-hmm. Well, that's because it leads. Like when people get afraid, and we just saw the new University of Michigan numbers saying that expectations for inflation have popped back up again, right? So when people think their money is going to become worth less, that's when people start buying gold. Yeah. So this sticky inflation story is really important. The Fed has guided it's going to be cutting rates. And, the Paul Krugman told us just last year that we beat inflation. There was a problem and it's gone. It's done. It's over. So for people to suddenly say, oh, wait, I thought we were told it was over. We don't have to worry about inflation. We're well on our way to 2%. And suddenly, no, it's gone back up to 3.5%. That's the kind of thing that I think can get this missing buyer into the marketplace, right, Jeremy. So that's the short version. And can't give you his ID tag, but there's a new buyer in this space that wasn't there before. And I do see that as very bullish.
Yeah. Despite prevailing uncertainties, Lobo Tiggre points out bullish factors bolstering gold prices, including ongoing central bank efforts to diversify away from the dollar and the Federal Reserve's commitment to rate cuts. Central banks, Chinese investors, and a growing number of Western buyers are actively promoting both gold and silver. Favorable macroeconomic conditions, such as anticipated interest rate cuts by the Federal Reserve, further support the case for gold and silver. Tiggre suggests that while short-term fluctuations are possible, the overall outlook for gold remains positive, with any corrections presenting potential profit-taking opportunities rather than signaling substantial downturns. If the conflict in the Middle East escalates, gold prices will likely extend their rebound towards $2,400. However, a resurgence in demand for the US dollar driven by increased safe haven flows and hawkish expectations from the US Federal Reserve could dampen the upward momentum of gold prices. Let's get back to the interview.
This new buyer, since we don't know who he or she is, how can we make any kind of reasonable projection for how long he or she will be buying? True. Right, so this is tricky, Jeremy. It's dangerous to make projections now. And as much as our Gold Bug audience would love for me to say, yeah, this is it, it's going to the moon, bye, a la Kramer, right? I have to say the rational answer here is that since we don't really know, and we won't until we have hindsight on this, know exactly who and why is buying, we cannot project how long that buying will be there. Now, the bottom line, Jeremy, is I remain bullish because even if this new source of buying dries up, if it stopped today, as you and I speak, that doesn't change central banks trying to de-dollarize. Right? Yeah. That trend is a one-way change. China is not going to suddenly want to go back to being dependent on Washington and New York for its transactions. So, that's a one-way change, and that's very bullish for gold. And, the Fed, despite everything, is still talking about, it's just bumps on the road. We're still on track to cut rates this year. And if they stick with that, rate cuts are also very bullish for gold. We could be, but I don't actually see any reason for, any substantial correction. If it got a bit ahead of itself, okay, it might correct a bit. But I'm actually not. A
little bit of profit taking.
Yeah, right. Nobody goes broke taking profits. I just saw, people get so emotional on Twitter. I just saw somebody on Twitter slamming me for posting $2,400 gold. Oh, it's gone. It's over. It's done. It's like, come on. You're talking about an intra-hour fluctuation. We didn't even know where it's going to close today. But okay, say it drops back to 23.50 or something. 23.50? Are you kidding me? That's a fantastic price. It's a price that makes, gold miners, even mediocre ones, gush cash at those levels if they haven't completely screwed up. And the gold projects out there, their price assumptions in their decision-making models, a $2,000 price assumption was an aggressive one. So those projects look great. So I'm actually not worried about gold at all. And I know you'll get there, but I'm quite interested. To me, the big surprise is silver, Jeremy. One, it's not an all-time high. It's a nominal high. If you inflation adjust, even using the government's nonsense CPI numbers, a real all-time high would be over $3,400 or 35 if I credit Mike Maloney's intraday peak in 1980. So we're a long way from a real high. And I think that's important to stress because gold is an alternative to the dollar. And if it's part of its value is disclosing the loss of value in the dollar, then I think that should be accounted for. The other thing I would say is, yes, the geopolitical tensions are all the headlines right now, but gold's been ramping up now for a couple of months. And this started, or the sort of hockey stick that we're seeing in the gold and silver stock charts, or sorry, not stock, but silver charts, that happened after October 6th and before this current escalation. So I don't think either can really be seen as the root cause here.
Bank of America commodity strategist Michael Widmer has set a target price of $3,000 per ounce for gold, expressing optimism about silver's performance. What are your thoughts on the factors influencing gold prices? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.